Hey guys, welcome to another episode of Tax Talk with Joel, and in today's episode, I'll be covering how W-2 employees can save money on taxes. If you're a W-2 employee, the amount of tax deductions you have access to are limited, especially compared to a business owner. I recently made a video listing 20 write-offs for business owners, and that was only scratching the surface. W-2 employees don't have this luxury, and as of 2018, because of the Tax Cuts and Jobs Act, W-2 employees lost even more deductions. For example, prior to 2018, all you had to do was buy a house, and you would get access to a bunch of extra write-offs. How did this work? Let me explain. So every American has the option to either take the standard deduction or to itemize their deductions. Standard deduction is a specific dollar amount that reduces the amount of income on which you're taxed. This dollar amount changes every year. But as of 2023, the standard deduction is $12,950 for single taxpayers and $25,900 for married taxpayers. On the other hand, itemized deductions are a range of deductible expenses allowable on your personal tax return. Some common itemized deductions include your mortgage interest on up to 2 homes, your state and local income or sales tax, property taxes, medical and dental expenses that exceed 7.5% of your adjusted gross income, and your charitable donations. So typically every American will use the standard deduction unless their itemized deductions exceed the standard deduction. Well, prior to 2018, it was very simple for your itemized deductions to exceed your standard deduction. All you really had to do was buy a home. For example, in 2017, the standard deduction was $6,350 for single taxpayers and $12,700 for married taxpayers. Well, when you bought a home, the mortgage interest and the property taxes alone would typically exceed the standard deduction. And if you exceeded the standard deduction, you would also be able to write off all the extra stuff, like your state and local taxes, charitable donations, and unreimbursed job expenses. So as you can see, itemizing your deductions can technically give you more potential to pay less in taxes than taking the standard deduction. However, the Tax Cuts and Jobs Act changed everything. Doubling the standard deduction made it so that simply buying a house would not be enough to exceed the standard deduction. And if you can't exceed the standard deduction, then that's a deduction you're going to take when it comes time to file your taxes. On top of that, the Tax Cuts and Jobs Act also eliminated the ability to write off unreimbursed job expenses, like the cost of uniforms, business miles, tools, and supplies. So with the increase in the standard deduction and the elimination of deducting unreimbursed job expenses, W-2 employees are now limited on what they can do to lower their tax liability. However, I've got some recommendations that can help you pay less in taxes. First, you need to understand that the tax laws were made to benefit entrepreneurs and real estate investors. This is because entrepreneurs typically create jobs and real estate investors provide housing, which benefits the economy. You see, the tax laws are incentives from the government to help stimulate the economy. So my first recommendation is to turn your passion into a side hustle. Let's say you like to travel. Well, you might consider starting a YouTube channel or a blog on the best places to travel in the world. When you start this side hustle, a portion of your everyday expenses will become tax deductible. For example, your internet is typically not deductible. However, the moment that you start a side business, your internet is now deductible. Another example would be your cell phone. Your cell phone bill is typically not tax deductible, but when you start your side business, now it is. Just keep in mind your side business must be motivated by profit. If you're simply starting your side business to deduct everyday expenses, your expenses can be disallowed by the IRS due to the IRS considering your side hustle a hobby as opposed to a business. So keep this in mind. Don't start a business to pay less in taxes. Start a business to make money and then use your business expenses to pay less in taxes. My second recommendation is to invest in real estate. As I mentioned earlier, the tax laws were made to benefit entrepreneurs and real estate investors. When you invest in real estate, you typically get to depreciate the building over 27.5 years if it's a residential property, or 39 years if it's a commercial property. You can also deduct all other operating expenses like the interest on the loan, the property taxes, and the cost of repairs and maintenance. While these operating expenses, along with the depreciation, typically will wipe out whatever rental income you made. This concept is known as earn in pocket but lose on paper. It basically means you're making money, but on your tax return it shows as a loss. For example, let's say you purchase a fourplex apartment building for $1 million and your rental income on this property is $2,000 a unit per month. This would mean that your rental income is $8,000 per month. Let's say your mortgage payment on this property is $6,000 a month. Well, that would mean that your monthly profit on this fourplex apartment building is $2,000 or $24,000 a year. As I mentioned earlier, you get to depreciate the building as a deduction on your tax return, while apartment buildings that have 1 to 4 units are considered residential. Once it's 5 or more units, it's considered a commercial property. So the building in this example would be depreciated over 27.5 years. So to calculate the depreciation, we would subtract the value of the land from the total purchase price. Let's say the value of the land is 20% of the purchase price. That would mean that the value of the land is $200,000. So after subtracting the value of the land, or $200,000, from the purchase price of $1 million, that would mean the value of the building is $800,000. Well, we would then divide the $800,000 by 27.5 years, which is a depreciation deduction of $29,090. Well, this $29,000 depreciation deduction would be an expense on your tax return. So you went from $24,000 in profit to a $5,000 loss on paper. This would be an example of earn in pocket but lose on paper. Now, there are other factors to consider. For example, the entire mortgage payment is not tax deductible. Only the interest portion of the payment is deductible. You can also deduct other operating expenses like repairs and maintenance, your home warranty, and any cleaning supplies. But essentially, this is how you can use real estate paper losses to offset your active income from your W-2 job. However, keep in mind that real estate losses are limited to $25,000. And once your adjusted gross income is more than $150,000, these real estate losses are suspended and carried over to future years. But here's a tax hack to get around that. Let's say you have a non-working spouse. Well, if you make her in charge of the day-to-day activities, she can be considered a real estate professional. And real estate professionals have access to even more tax breaks. She wouldn't even be required to get a real estate license. She simply would need to work more than 50% of her time in real estate and devote at least 750 hours a year to real estate. Once she qualifies as a real estate professional, your losses are no longer limited to $25,000. They actually become unlimited. The best part is that these real estate losses can offset active income like the income from your W-2 job. And these paper losses can amount to large dollar amounts, which can be used to offset your active income and theoretically help you save tens of thousands of dollars in taxes. And the more real estate you buy, the more paper losses you will have. We have clients that we do this for, and they're saving tens of thousands of dollars in taxes every year. We typically find that by doing this real estate strategy alone, they usually save about $25,967 annually. This is money that can be used to go on a much needed family vacation, for retirement, or to simply buy more real estate and grow your wealth. Let me know what you would do with it in the comments down below. So that's it for this video, guys. If you would like to implement the tax strategy I just mentioned, you can schedule a free 15-minute discovery call by going to sandovaltax.com/YouTube. We'll put the link in the description down below and you can schedule yourself in for a call. If you learned something new today, please like, comment, and subscribe. And if you want to learn more, hit the bell as well so that you're notified when I drop the next video. Until next time, you guys have a great and amazing day.